look, all of us, I think, at this point have to be humble and recognize that we don't really know what the policy framework is going to look like. And to a certain degree, I think that in and of itself is the issue. You get the sense from talking to businesses over the course of this year that they have generally assumed that the Liberation Day tariffs would not go into effect, that we'd settle at a much lower level. The numbers that came out over the weekend are a lot higher than people had assumed they were going to be. And so I look at businesses who might have thought, okay, we don't have to pass these costs through right away because we're going to settle at a lower number, who are now looking at higher numbers again. How long can they go without passing those prices on to consumers? Maybe you can do it for a little while, but if we're going to end up at 30% instead of 10%, I have to believe they're going to pass those through.
So what does that mean for the economy? We thought, the initial concerns were lower growth, higher inflation. Maybe we've seen some lower growth, but we haven't seen the inflation. What do you think the net effect of, I guess, the tariffs, maybe just the uncertainty around the discussion of tariffs, how that's going to affect this economy?
Yeah, so that gets to my point, which is I think you're right. We have seen some slower growth. We haven't really seen the impact on inflation, and I don't expect to see a significant impact really on the inflation data we get tomorrow. But that's in large part because businesses have been patient rather than passing things through in the assumption that tariffs are going to be lower than what they were announced to be. And now if they aren't, they're probably going to start passing them through.
Paul, Yale Budget Lab writing Friday, and they say they're going to rewrite this morning. I'm sure they're not. Ernie Tedeschi, he doesn't get into 10:15.
Exactly.
It's the way they roll at Yale. Okay, Paul, current tariff, average effective tariff, ready? 18.7% since 1933. And after the consumption shifts and adapt to it, it'll come down to 17.9%, the highest since 1934.
Okay.
That's nuts.
That's nuts. And so, Eric, if you're the U.S. Federal Reserve, how do you view this kind of environment, the higher tariff level? Does that mean you need to be more attuned to growth statistics and maybe the impact on inflation?
So look, the answer for the Fed is that tariffs push them away from their mandate in both directions. They slow growth and they push prices up. So it's a very uncomfortable policy framework for the Fed. And I think that you do what they have done, which is you wait to see which of those trends predominate. If the labor market were to weaken, then you have to respond to that. It hasn't so far, or at least not in a way that makes them respond. On the other side of that coin, if prices were to move up in a way that impacts inflation expectations, then you have to respond to that. And until you see which one it is, you do nothing.